Hey, what's going on, guys? Thanks for tuning in to today's episode of ACM Insider featuring our very own Mac Church. Mac is a senior loan officer here at ACM and operates out of our Fredericksburg branch. Mac, how's it going today, my friend? How you doing?
It is going fantastic today. Very, very busy, which is good.
I know it is. It is definitely a busy season. I can't talk today. So Mac, you've been in the mortgage business for over 16 years, which means you certainly have a wealth of knowledge and experience. That also means you've seen a lot of changes happen in the mortgage industry and the home buying market, throughout the course of your career. So let's kind of kick this off by you telling us a little bit about how and why you chose the mortgage industry as your career path.
So I chose the mortgage industry actually on a whim. One of my best friends was in the business, and he knew of my background, which was I had a marketing degree from college. And a lot of the jobs I had been doing were in restaurant and retail. I was in the management arena as area manager. So I had a lot of experience with customer service and doing a lot of local store marketing and dealing with issues and problems and clients and things like that. So I had a very good preparation for the mortgage industry. But he just thought that my skill set for what I had learned over the years in my other professions would translate well into the mortgage industry. So that's how I got in, and came in with zero experience, of course. And 16 years later, here I still am.
Yeah, safe to say you've learned a thing or two since you first started. And speaking along those lines, let's jump into the nitty-gritty of it all and really be able to start extracting some value from that experience and knowledge that you have to really help home buyers, regardless of what situation they're in, whether they're refinancing, purchasing, as well as just being able to understand how to navigate the market that we're in right now.
Sure.
One of the first questions I have for you is, as a home buyer, should I hire a realtor first or get pre-qualified first?
So that's the $1 million question, and
Right.
probably the majority of people actually hire a real estate agent first. But in all reality, the pecking order really should be to get qualified first.
Right.
That way, you know exactly what you can afford. You can figure out what kind of payments you want to be in, and then from there, then you find out what you want to look for, and then that's the best time to contact a realtor, because if you go to them first, they're going to end up sending you back to me anyway. So you always want to get qualified first, so that way it kind of streamlines the process and just makes it a lot easier for everybody. So you definitely reach out to a lender first to get pre-qualified or pre-approved.
Yeah, I think a lot of times people, they're focused in on the house, which a lot of times is directly correlated to the realtor. So as they're looking, it's like their mind goes to like, oh, well, this is what I need to do first. But it's kind of like as with anything else. It's like, you go to the grocery store or you're going to Macy's or Nordstrom or anywhere else. It's like before you're going to actually buy something, even if you don't necessarily even know what it is you want, you just have a general idea. You first have to know how much money you have in the bank or how much you can spend on it. And I think that's kind of where people a lot of times get those two pieces reversed. Would you agree with that?
Oh yeah, definitely. The other part of that is the home buying or the home searching part is fun.
Right.
So
exactly.
That's the fun part. That's what everybody wants to do. And the lender or the financial part is the part nobody really wants to deal with.
Right.
So we call ourselves reality, and searching for the home is the dream. So most people want it to go for the dream before they want to be in reality.
Yeah, I love that. But I think that what I'm hearing is the biggest benefit in terms of getting pre-qualified first is it gives you the ability to actually find the houses that, the worst thing you could do is you fall in love with the house and then you find out you can't afford the house. And then a lot of times people will try and figure out every which way possible of, well, how can I get into that house? When, even if they are able to find a way, it's not really going to be advantageous, because then they're probably going to be strapped in terms of what that monthly mortgage payment is. So I love what you're saying as far as getting pre-qualified first. setting that foundation, knowing exactly what kind of home, or, the amount that you can afford, and then being able to do, like you talked about, being able to actually go after the dream, do the fun stuff of like actually looking for a home. That makes total sense. So I have a follow-up question along those same lines is, particularly for first-time home buyers, there's always a question of, do I need money for a down payment, right? Or can I get a loan with zero down payment? So can a first-time home buyer get a loan with no money down? What are your thoughts there?
They absolutely can. In fact, you don't even need to be a first-time home buyer for a zero money down. There's a loan called USDA Rural Development, and it's 100% financing. And as long as you do not own a property at the time of your closing, you can take advantage of this loan. It is a income qualified or income eligible loan program, as well as a property location eligible loan program, but you can still get 100% financing. And then, of course, the Virginia Housing Development Authority offers a few different loan programs that are zero down. So, but even with the zero down, it doesn't mean you don't need money, because
Right.
Because that comes into question a lot of times. But you still have to have money for your earnest money deposit to give to the sellers. Still have to pay for an appraisal up front, and most people will want to order a home inspection. So usually the out of pocket is normally going to be between $1,500 to $2,000. So I didn't want anybody to get confused with the fact of no money down does not mean no money at all.
Right. Yeah, that's a great distinction. That's a great distinction. Because I think a lot of people, when they hear no money down, they're thinking, okay, that applies to everything, and that's not the case, as you just pointed out. So since we're talking about the whole financial aspect, obviously being a mortgage lender, one of the questions that a lot of people will talk about revolve around credit scores. And there's a lot of confusion that I see, or, talking to some of our other loan officers or, our borrowers, there's sometimes confusion around the credit scores, particularly around, why are credit scores different from what they pull on the consumer side versus what you're pulling on the lender side?
Well, this is the part that is definitely the most confusing, and the simple answer to that is that mortgage lending credit reports are using a different algorithm than all of the online credit reports. So what that means is a mortgage credit report is going to assign different percentages to credit for different things, such as on a mortgage credit report, the paying on time is great, but it actually helps you, or is more beneficial if you're not only paying on time, but that you're managing your debt. Whereas something online, when you pull, if you've had perfect pay history, it really kind of doesn't matter as much on the debt that you hold in comparison to the credit limits as it does on a mortgage. So yeah, the mortgage credit reports are different from what you pull online. And even if you go through a credit bureau directly online, it's still going to differ from what the mortgage report is. So there's a lot of different online applications that people can use. And I say use those just as a barometer to see where your credit is, as far as, are you on time, what's your total debt. But don't use those scores as the be all end all, because what happens is somebody calls the mortgage loan officer, we pull their credit, and it's usually between 20 to 40 points lower on our report than what it is online. So it's a great barometer just to see where you're at as far as your debt to credit limit, and that you're paying on time. But as far as scoring goes, it's really not reliable.
Right. No, that makes total sense. So if we're kind of staying in that same vein of, we're talking about credit score and money down, that kind of leads to another topic that sort of correlates with all that, which is around rates, right? And I think a lot of people ask an interesting question around, why do, Mac, why do some people get this rate and I'm getting this rate. What is the difference? Is that based upon geolocation? Is it based upon the size of the home? Is it based upon, what is it based upon, I guess, is a general question. And why do people get those different rates, right?
It is based on so many different factors.
Right.
And the one thing that I get a lot of, well, my neighbor got this or my brother got this. Well, how come I don't get that same rate? Which is exactly the question you're asking. Because it's based on the type of loan you're getting.
Right.
Different loan programs actually have different rates. It also depends on your credit score. So credit scores go in 20-point tiers as far as rates go. So the higher your score, you're going to get the best rate possible. The lower your score, you're not going to get the best rate, or you're going to pay a higher fee for the same rate. Most people don't want to pay points for loans, so rather than pay a point for a loan, they're just going to go up in the rate that's free. So the other thing is loan to value. So if someone's putting down 5% or 3% versus 20%, their risk is going to be higher. Therefore, the fee that Fannie Mae or Freddie Mac is going to charge is going to be higher. And then once again, that borrower will usually choose to take a rate that there's no fee on, which is going to end up being higher. So there's a lot of different aspects to rates, but generally it's usually the loan program and the credit score are the two main factors in what the difference of a rate is going to be.
So if we're talking about the rate, and obviously right now the rates are, they're probably at an all-time low, or at least one of them.
They are the lowest in history right now.
Right. And right now we are just started September of 2020. So, we've all been dealing with the Corona stuff, our coronavirus, and kind of navigating that. And part of that has kind of spilled into the Federal Reserve, right? And so the question is, in terms of the Federal Reserve interest rates, does that actually impact the mortgage interest rates as well?
Well, the Federal Reserve interest rate actually does not have anything to do with mortgage interest rates.
Okay.
So that's a big confusion around interest rates. What the Federal Reserve rate is that's what banks get their money on. So if you have a bank that's going to lend money on personal loans, home equity lines of credit, car loans, that's the rate that they're getting their loan on. Then they're able to pass that cheaper rate on to customers. The mortgage rates are based on the Treasury bonds. So those are completely two different things. Now, a lot of times when the economic sector sees that the Federal Reserve is going to lower rates, then usually that's going to cause some effect in the mortgage market. And they may prepare for that by increasing the mortgage Treasury bond just a bit, which will make the rates maybe a tad pricier. But when you hear the Fed drop the rate 0.25%, it has no bearing on the mortgage interest rates. Mortgage interest rates do not drop 0.25% when the Fed does. So it's two completely different things. And but the normal response we get is, hey, the Fed dropped 0.25 point. Does that mean my interest rate's going to go down 0.25? And the answer is no.
Yeah. No, that's really helpful. And that's one of the reasons why I asked this, because we get asked that all the time. I think there's that confusion between what the correlation is or what the correlation isn't. So thanks for clarifying that. Now, as we're going through, and like we just talked about, the rates are incredibly low right now. So you have people that are refinancing and then other people that are actually looking to purchase, that are still doing well throughout this time period. What is your take on the housing market right now? Is it one of those things, particularly for where you're at in Fredericksburg and some of the other areas of Virginia that you service, in terms of buying a home? Do you feel like it's something that is you're seeing that it's more difficult for people in terms of inventory within the housing market, that's very limited right now? What are your thoughts on that, as far as whether it's difficult right now to kind of find your dream home for a lot of the buyers that are out there?
Yes, the answer to that is yes. So I'm actually able to lend in North Carolina and Maryland as well. Yep. And I'm seeing the same thing in those states as well as Virginia. It's across the nation right now, there's a lack of inventory. And when that happens, you have supply, which is very low, versus demand, which is high by the amount of buyers out there wanting to buy. And whenever we have this kind of issue with low inventory, it makes it become a seller's market. And when there's a seller's market, that usually will end up with a couple of things happening. The first is it drives the home prices up, because now the market bears a higher degree of want for a certain house, and there's a lot more competition to get that house. So you'll have buyers start to offer more than what the house list price is. So you get a driving up of the home price, which then drives up the value of the homes as well, which is not such a bad thing, but you saw what happened back in 2006 and 2007.
Yeah.
So, we hopefully we've learned from that and learned to manage that a little bit better across the industry. But the other thing is when it's a seller's market, the sellers are not going to be as obliging as normal with helping a buyer out with closing cost assistance,
right,
or negotiations.
Because they have so many buyers there that are readily available.
Exactly. They're going to get whatever they want.
Right.
And that makes it tough on a lot of people, because especially our first-time buyers or the people who do need 100% financing, well, if they don't have money to put down, then they're not going to have money for closing costs. So it really makes the part of being able to buy a home a lot tougher.
Right.
And it kind of goes back to the haves and the have-nots. It just if you're on the lower side of the spectrum where you don't have a lot of money, then it really does make it a lot more difficult to buy a home.
Yep.
So that's what we're seeing right now in the market. That yes, it's a very tough market, and what we need people to realize is that if you own a home, it is the best time in the world to sell, because you're going to get full price, not have to pay anything out for closing costs, and then when you turn around and you go to buy a house, yeah, you might have to deal with the same thing and paying full price or maybe over, but the rates are so low right now, you're going to be in a better financial position, and you can actually trade up in a house and have the same mortgage payment or lower than you have currently. So I'm surprised that more people are not putting their houses on the market as is.
Yeah, no, that makes total sense. Do you think do you think the result of that is because people are nervous right now? Again, we're dealing with coronavirus. I guess it depends upon, someone's work situation and whatnot. But do you feel like that those are really the factors of why that people aren't, making that, like the shift, like you just talked about, where it's, I have house A right here. I could sell that, get full asking price, probably even a little bit more, while at the same time being able to get an incredibly low interest rate that would allow me to actually step up in terms of maybe getting a little bit more space, maybe a nicer area or more yard, whatever the case is, or whatever it is you're particularly looking for. It affords you that ability to do more. Why do you think some people are more hesitant, even if they would like to kind of step out and explore that option?
So you're right about the coronavirus. That definitely has something to do with it. People are nervous.
Right.
But I think the real thing is that I think most homeowners don't realize the value now that they have in their homes. People have been underwater or stuck in such a rut with values for the last 10 years that just in the last couple of years, they've actually started rising. And we're not talking normal appreciation of 2 to maybe 3% a year. We're talking 5 to 10%. So in the last 2 years, you could have gained 20% in equity, and but people don't realize it. They don't know that they actually have the equity in their homes to be able to sell. There's the entire home buying segment right now. You figure most people are in their homes for 10 years, or it used to be about 7. Well, now people are staying in their homes longer. Now we're looking at 10 to 12 years. So you're not having that turnover of homes as well. So you figure by the time we got out of the home bubble burst, and we're in not 2009, 2010, well, that whole segment of buyers now is now coming up on their 9th or 10th year, and they don't know. They haven't realized the value that's in their homes right now. So I think that may be a big part of it. Coronavirus certainly adds to it, but I think it's just the general lack of knowledge out there upon homeowners that what they could do, And I know that our realtor friends are out there pushing it as much as they can and trying to educate everyone out there. But I think that's the main thing, is just the lack of understanding or knowledge of what's going on in the market right now.
No, I love that. So would your advice be for those individuals, they own their home, they've thought about maybe stepping up or maybe moving to a different area or finding a home that meets some needs that maybe their current home isn't? What would your advice be to them? Would it just be just going and having an appraisal done, or talking to your local lender along with your, someone that you trust from a real estate standpoint? What would your advice be to those individuals so they could actually test the waters and have a better gauge of, what options are actually available to them?
So that one is the opposite of when you first, want to buy a home. That one, you want to reach out to a realtor so they can do a competitive market analysis for you and see just what they think your house would sell for. Then you can figure out what's the shape that the home is in. Is it ready to go right now, or should some repairs be made first to get the most money out of the property as possible? And then you want to go to your lender to see, okay, what will I qualify for now that I know that I'm going to make X amount of dollars on the home, and I can put this money down towards the next home I'm going to buy. So that's one where they're going to where they do want to reach out to a real estate professional that has a lot of listing experience.
I love it. That's great advice. So I know we're kind of getting near the end of our time together today. So I have two quick questions for you. One, just going back towards more of the purchase side of things, is, another question that we get a lot of times revolves around closing costs. And the question being, can you roll the closing costs into your loan, or are you not able to do that? So now that we have you here to definitively answer that, Matt, what are our options here? Can we roll our closing costs into our loan, or is that not an option to us?
Man, I wish you could, but that is not an option, with the exception of one loan. Now, refinances, of course, if you have the equity, you certainly can roll your closing costs in, which is a huge benefit. But for purchases, there's only one loan that allows you to roll closing costs into the loan, and that is the USDA Rural Development Loan. But it's only in the case if the appraisal comes in higher than the purchase price. So USDA will allow that variance in between your purchase price and your appraisal value. If there is a variance, you can then take that difference and roll that into your loan to pay towards closing costs. I think a lot of people get confused with some of the loans like VA and FHA, which have what they call either guarantee or upfront funding fees, and those can be rolled into the loan. So they're considered closing costs, but because they're government fees, they can be rolled into the loan, and they're not really considered an out of pocket. Yep. So that might confuse some people, but the actual fees and prepaids and escrows and all of that good stuff, it is not allowed to be rolled into the loan, because the last thing investors want to do is start off in loans upside down, where the buyer owes more than the house is worth to begin the process with. So the answer is no.
Yeah, and that makes total sense. And for people, based on what you were talking about for the USDA side, I'm sure some people are going to be like, I definitely want to do the USDA because of this one little slice of it. What would your recommendation or advice be to them where they're getting hung up on maybe that one specific piece that in the grand scheme of things may not even be the best fit or the most relevant option for them? What would your advice be to them in terms of, the ones that are kind of like, their eyes light up and they're like, this is USDA is now the option I have to go with because I have the ability to potentially roll in closing costs from that standpoint? What would your advice be to them?
that's probably not a great way to go.
Yeah, right.
If that's what you're doing, because if the house comes back at the value of the purchase price, you can't roll anything in. So if you're holding on to the wish of being able to roll closing in, and that value comes back at the same, well, now you're kind of stuck. So that should be a benefit of the program, but never should be something that you hang your hat on.
Yeah.
So I would not do that loan just because of that reason. You do the loan because it's a great loan. It's 100% financing. However, there are eligible restrictions as far as income and where the property is located. So you have to meet all those different guidelines to be able to get the loan in the first place, but you never would want to make a decision just based on that mere fact.
Yeah, no, I think that's great. It kind of goes back to the whole don't major on the minors and minor on the majors. It's like focus in on getting the actual best loan for your situation, which every situation is completely different, even though there's a lot that are similar, but every situation truly is different. That's where being able to talk to an experienced mortgage professional like yourself is so crucial to that process, because you can serve as the guide for them throughout that financial transaction, where otherwise they're kind of left out in the cold trying to fend for themselves, which at the end of the day, nobody wants to be in that position. And, from a home buying standpoint, buying a home, yes, there's going to be stressful, but it should be a great experience. So being able to have somebody like yourself affords them the ability to be able to have that experience and to focus really, like you talked about, on their dream versus necessarily the steps having to get there, because they have someone who's kind of holding their hand and guiding them along the way.
Exactly.
So I have one final question for you, Mac. I need you to think long and hard about this.
Okay.
Get tuned in. Get tuned in. If you can give one final piece of advice for home buying clients, what would that final piece of advice be for everybody listening?
Get your ducks in a row before you want to buy. And that means getting pre-qualified and pre-approved first, then seeking out your realtor professional to look for the house. There is nothing more frustrating for a buyer than what goes back to what you were saying earlier, than to find a home that you fall in love with and then come to find out that you can't afford it. If you ever want to take an example of that, watch a show on HGTV called The Property Brothers.
Yeah.
They love to take people around and show them this beautiful house, and then they tell them this is the price. People are like, oh man, we can't get that.
Yeah.
And then they say, well, we can find a fixer-upper and make into this for a lot less money, but you want to get your financial plan in order, and that's what I find the most successful borrowers are, or who the most successful borrowers are, that have the most fun during the process, and that have the least amount of strain or stress during the process as well. The ones who prepare are the ones who end up with the best experience for the loan program.
I love it. So Mac, for those that may be in North Carolina, the Fredericksburg area, i.e. Virginia, or in Maryland, who are looking to connect with an experienced, well-seasoned loan officer, what is the best way for people to connect with you on social or through the web?
Either one. Through the web, if they go to my webpage, which is www.macchurchhomeloans.com, there's a get pre-qualified button for an application. There's a contact me. There's information on the website that will help them see the different loan options. But usually just hitting the contact me button is the best way to get in touch with me. Certainly they can call as well, but an email usually is going to be the quickest way. And then I always like to set up an appointment through Calendly, which is my scheduler. And that way I can meet with them at a time that's available for me and the client, and then we can talk about their hopes and dreams and how we're going to accomplish that.
Perfect. So if you're in the Virginia, Maryland, North Carolina area, and you're looking for an experienced and knowledgeable loan officer that can help you get into your dream home, my guy, Mac Church right here is a great option to go with. We'll put his contact information somewhere in the post around here. But Mac, thanks for joining us today. Thanks for all the knowledge that you shared with us today. It was definitely helpful. And everybody else, thanks for tuning in. We look forward to catching you in the next episode of ACM Insider. Mac, take care. We'll catch you next time, my friend.
Thank you, Corey. Have a great day.
You too. We'll see you.
Bye-bye.
Hey, really quick before you go, if you enjoyed this content, be sure to follow us here on social and don't forget to like and share this content. Thanks for tuning in, and we'll catch you in the next episode.